Hello, future millionaires, and welcome back to another episode of attempting to turn 10k to 100k over time. And today, I'm not going to share about my market outlooks or what stock I'm going to add into my portfolio, right? But rather, I'm going to share something that's a little bit more uh, along the edges of investing principles, and that's knowing when to exactly sell a stock. So, why I feel this topic is important to share is because it directly impacts how much you can write onto your winners and to gain more profits over time, and to minimize your losses, and don't waste your time like holding on to losers and eventually leading to a bigger drawdown when you add on to it, things like that. So knowing when to sell a stock is so important because I think it affects your personality types. It involves your personality, knowing what kind of investor you are, how you deal with your emotions when you are in profit or when you're losses. It's very important, especially because it spills over to risk management as well. So I feel that there are four main ways of knowing when you should sell a stock, and especially when you're in profit, right? So number one is you feel that the stock's valuation is overly extended and that it's in bubbly territory. So there are two ways to look at this, right? Number one is just looking at the pure valuation matrix of the company you're invested in. Your PE ratios, your price to sales ratio, they are like way above the historical mean, hitting crazy amounts, crazily high amounts. And second is societal cues, right? So you're looking at your friends and families. They're all like very interested in buying into stock markets nowadays. Keep asking for your opinion, and they're asking whether they can buy into the stock, or rather they could also be showing off their profits to you, right? How much they've been gaining recently because of the stock. But that said, valuations wise, right, high can go higher. So let's take two stocks for example. So number one is a stock called DocuSign, right? If you look at DocuSign, by the way, this is StockPenguins.com. I'm using it to show like all your financial figures and metrics, things like that. So if you look at DocuSign, I don't think it's a very good view. Let's use the new view, key ratios. I already preloaded it. Yeah, the price to sales ratio. Right, let's look at it over the past 10 years. So for example, if you bought into DocuSign back in 2021, the peak of the bubble, right, on hindsight, its price to sales ratio is a crazy high of over 100. And in order to sustain this kind of ratio, and the company has to either be growing crazily right now, and also will be expected to do so going ahead in the near future, in the longer future, it's expected to grow at such crazy rates to be able to justify this valuation. But look at what happened later on, right? Valuation started to crater once the market crashed because of rate hikes, right? Valuation started to crater, and DocuSign's share prices never really recovered even up to today, right? From a high of close to $300, and now they're trading at $80, and even hit a low of around $30 plus dollars back in 2023. So you shouldn't just based on super high valuations, you should consider selling a stock, especially when you feel that the business is not able to rationally sustain its growth going ahead in the future, right? But that said, high can go higher, like what I mentioned earlier. For example, Palantir. So if you look at Palantir, right, Palantir's share price, if you think its valuation is like extreme, right, over the past 2 years, the stock prices continue to rally crazily, right? From let's say even at $30, people are feeling like, oh, the valuation is so high, but then it continues rallying, and up to today it's trading at $165. But why is this so? Why is Palantir able to sustain its valuations while DocuSign, on the other hand, has its valuation created? So always go back to your fundamentals, right? Palantir is a company that has been able to sustain its growth rates for the past couple of quarters, and is projecting very strong guidances as well. And if you notice, right, Palantir's products and services have like not much competitors out there. I would say they don't even have competitors, right? Their product and services mode and advantage so strong to the extent that its gross margins is around 80%, which means that there's not much competitors out there. They can price very strongly. As conversely, if you look at DocuSign, right, it's a software tool business, right? It's a SaaS business. There are many other tools out there that could replace it. And if you even want to, you can just sign the documents yourself, right? You save money on that. Conversely, if you look at Palantir, its data analytics, its data, its models, all that, it's a very strong product mode. It's able to do things that its competitors are not able to. And if you don't use Palantir as a business or even as government agency, you're losing a lot in terms of like your redundancy and cost. And Palantir provides a lot more accuracy in a sense, right? And if you look at Palantir's fundamentals, let's use the overview for this, right? Let's go financial overview. We look at Palantir's growth, very solid, very strong growth, revenue growth, growing very steadily, very strong gross margins, net income profitable, still growing very strongly, right? Net income over the roof, free cash flow very strong, growing very strongly. Yep. And if you compare that to maybe DocuSign, you probably see like very, very slow growth. And then the other thing is the narrative is backing Palantir compared to companies like DocuSign. So if you look at Palantir, it's in the AI space. In the past few years, everything's about AI, right? If you invest in any AI names, you probably be sitting on a big pile of cash right now. But on the other hand, if you look at DocuSign, it's in the SaaS business, the software business that's being disrupted by AI at the moment. So if the narrative is going against you, you probably either want to take profits quick when you're in the green, or if the narrative is going with you, you probably should just let it ride out, you should hold on to the stock, especially when the fundamentals are still growing very strongly and its valuations is sort of more or less like validated, even though it's a lot higher, right? And number two, when you should sell a stock is when you hit your technical price target. So if you're a technical trader, so you're trading based on chart patterns and things like that, it's best that you just stick to your trading rules, right? It's very important to differentiate between a trade and an investment. You don't want a trade to become an investment, and that's where you will probably see, for example, if you long at a certain price broke down, and then you're thinking, oh, it could bounce back, you keep on adding to your losses, and then just becomes a bigger loss at the end of the day. And so I think it's very important to differentiate trading and investing. If you're on trading, your stock price hits your price target, you just get out and wait for the next trade to happen, right? Because you're just refreshing your capital. And another thing is number three, right, is when your investment thesis is invalidated. So for example, right, I could have invested in this company called Lululemon, right, back in 2021, 2022, where it's still growing very strongly. These products are still, but it's yoga pants or tights are still the talk of the town. Everybody's wearing it, all your influencers, your movie stars, your friends, they're all buying it, right? They're all showing it off. It's still the in thing. So this probably means that the company is still expanding very nicely. But in today's climate, right, Lululemon's stock price has tanked a lot recently, right? If you look at the past 1 year, it's created quite strongly, down over 36% from 1 year ago. And if you look at Lululemon's growth rate revenue, right, it's slowing down crazily, right? And it's slowing down because of a competition. You have like your Alo yoga pants coming to the market, disrupting its Lululemon's US store growth, right? Overseas expansion, yes, it's still growing for now for Lululemon, but when this competition enter these markets as well, probably you'll see Lululemon hit a brick wall. And Lululemon even mentioned it themselves, right, that their management has not been that on the ball in capturing product trends and release cycles recently. They're not gaining the results that they want from the new launches. So when a company is losing its edge and growth is slowing, and that's exactly the opposite of why you invested in the company in the first place. If you're in the green, you're in the profit, you should probably sell the stock to lock in your profits. Or if you're in the losses, right, you probably should think of reallocating your capital somewhere else until you see the company starting to make a comeback in terms of its narrative, right? And another example will be when there are certain companies that you invested in because of its earning modes, right? And this is very evident in the pharmaceutical industry. For example, you're invested in a stock that has some kind of patents on its weight loss products, right? But then because of some lawsuits or some fair competition thing, the patents, right, got removed from the company. And this will mean that a lot of competitors can just flood the market with this kind of products, and the earning potential and power of the company who had the patents, right, that you already invested in previously, has lost its mojo. So this is probably why when you should get out if you're in the profit, and cut your losses as well if you're in the red, right? Number 4 is when a narrative is going against your investment. Like I mentioned earlier, the example with DocuSign, right? That's one. Another one I'd like to share personally is Alibaba, right? So I invested in Alibaba back in 2021, 2022, when stock prices has dropped quite heavily, and I thought it's a good value play. I should go into it and should buy it. But the narrative was going against Alibaba at that point of time, right? There was the whole property property market collapsing in China, and you have the whole CCP cracking down on the big tech companies over there. They're like running a lot of antitrust lawsuits, things like that. They're cramping down on their monopoly, right? Which means that a lot of new entrants that come to the space and compete with them, and then there goes their margins or their future earnings growth power to price it heavily. So on hindsight, I shouldn't have done that because the stock continued to drop more. Thank God I didn't hold on all the way to the bottom. I cut my losses early. But I think some people will continue to take this as an opportunity to continue adding on, right? But instead, if the narrative is going against your investment, you should probably get out if you're on the green, like I mentioned earlier, and cut your losses, because you don't know how long this narrative can last. Your money could be better placed somewhere else where the narrative is going for you rather than against you, right? And another besides selling the profits, right, there's also another thing of when should you sell, when should you hold on to the stock when you're in the drawdown. So this is directly just the opposite of what I mentioned earlier. So number one is when your investment thesis remains aligned and did not change. So one example would be Meta. So I invested in Meta back in 2022 or 2021 as well, right? I sold my stock because of the stock price kept going down, and I started to feel like a bit scared and paper-handed. I took a loss, but on hindsight, right, where I sold was pretty close to the bottom, and the stock price continued rallying all the way back up. I would have made like a good 5 times on my investment if I've held onto the stock. But what I've done on hindsight is to look at the fundamentals of Meta. So you look at Meta's fundamentals, right? Let's look over the past 10 years. Its revenue growth has been very, very, very strong, solid. Even such a large company is still growing at such double-digit rates, quarter over quarter, right? Net income still very strong, right? EBITDA very strong. Cash flow so much and still growing that high relative to the amount of operating cash flow he has. Free cash flow positive and still growing, right? Dividend started paying out dividends, right? Share outstanding over time is declining. Means the amount of shares you hold is getting more percentage based, proportional to the total float out there. And even if you think about Meta at the point in time, there were a lot of negative headlines about the company, like it's losing its mojo with the whole metaverse thingy. They're wasting a lot of money on that. There are many other competitors out there that could take market share from Meta. But if you look into the numbers, the number of hours people are spending on the app on a weekly basis is still climbing. Total overall number of users are still climbing very strongly. And Mark Zuckerberg, the founder, is still in charge. So if a founder is still leading a business and there's such strong growth, right, you should probably ignore media headlines and look into the numbers of the company and remain rational and not just cut your losses, especially if you bought at a decent price where valuation was okay. I think you could continue holding on the stock, which I actually have done. And number two is when the drawdown of the stock is not like because of the company, meaning it's not bottom-up induced, but rather top-down influence. So it could be like your geopolitical events, your wars, your random news here and there, right? So one good example would be, say, a war in the Middle East and versus a stock price declining of a US growth tech company that operates solely in the US, meaning all its customers are there, right? So a war in the Middle East may have some minor influence, through like butterfly effect or something like that, that will impact the business of tech growth company that you've invested in. But for some reason, the stock price tanked a lot because of this overall market shakedown. But the underlying business has not changed, right? The company has not lost a single customer. Its earnings are not affected. Its guidances are still there. Management is still guiding to strong growth. Fundamentals are still solid. There's no reason for you to sell the stock. Obviously, I think when such opportunity arises is when you should add more, because the company is giving you like going on a discount, right? So you should just buy it, right? But that said, there are certain economic data that you should be wary of. Number one would be your inflation data and your interest rate numbers, right? Because these numbers will directly impact your invested company's cost of borrowing. The cost of operating its business may be higher than before now when interest rate is higher, for instance, And when interest rate is higher, there could be more capital flowing out from your risk on assets to your risk-free assets, because now the yield is higher. So it doesn't pay to take that much risk anymore, right? So these are some situations where you could continue holding on to the stock when the price decline is not induced by the company itself, but from an overall external factor. And number 3 is to not be distracted by daily volatility. So one example would be Xiaomi, right? If you look at it's a Hong Kong stock. So I invested in the company around $20. So the company broke out, started trading higher. I think it hit around $24 range. Before there was some you can't see it exactly here, but there was some pullback because of just your daily volatility, your technical profit taking, and then I got shaken up by its volatility. I got scared, so I quickly book my profit in. But then, the stock continued rallying higher, and I missed out on like a potential 150% gain, right? So do not ever be distracted by daily volatility. You must have the stomach to hold through your losses and your gains, right? And write out your gains when there is some kind of noise in the market, right? But the underlying fundamentals didn't change that much, and the valuation that you bought in is quite decent, correct? And I think that'll be all for knowing when you should hold a stock when you're on the drawdown. And lastly, I would like to part with the advice. It's always best not to add on to your losers as it's falling, especially when there isn't a change or catalyst coming up. So don't keep adding on to your losses, right? Your small loss at the start, if you keep adding on to it, could become something big, and you'll be left holding the bag. So only add on to your losses when you feel, or there's a change coming up, there's a catalyst coming up, or the valuation is really that low that you feel that but there's still a need for your catalyst, right? Do not add on to your losers, but at the same time, don't be afraid to add on to your winners when the company is still doing very strongly, and then there are like this kind of geopolitical events that give you some discount to buy at decent valuations. But that's all. Thank you.